All right, welcome back to another video. My name is Robin, and as per usual, I am joined by Kirill. And yeah, so what are we gonna discuss today, Kirill?
Well, we are gonna discuss right after the second video again our lovely upcoming web app, and on top of that, we're also gonna check Amazon, who also it was hit pretty hard today. Not today, Friday, and there's maybe something interesting we can look into, huh?
Exactly. So let's go.
Yeah.
So what was on the news? Amazon share slides on revenue miss, disappointing guidance for third quarter. So see, these are all, of course, things that make sure that the stock goes down. But there's more to unravel here, as we will discuss. But yeah, is it really gloomy as they say it is? Is it now correctly valued? Can you buy it in now it's dipping? That's some things that we're going to discuss. Yes, and of course, if this is the first time you've been watching since or at all, or if this is the first time since a long time that you've been watching us, we will also present our web, as Kirill said. So let's get right into that.
We're finally back in business, baby. Let's go.
All right. So what I want to touch on is I checked the Amazon quarterly second quarter results, and they focus on revenue, but of course revenue itself gives a bit of guidance. But I also want to say they didn't have match their revenue. But it says here that their net income increased to 13.5 billion in the second quarter, which is almost double or more than double the second quarter in 2023. So okay, they're not making the revenue, but they are of course either making their business quite efficient. So I don't think that's a bad thing at all. But yeah, again, one metric that I found here. But yeah, other things in the second quarter also increasing, for example, free cash flow. So yeah, they didn't make the revenue, but other things are looking pretty positive. So before we jump in, actually, let's just tell you what we're gonna discuss in this video. We're gonna give you the company overview, what's Amazon, what's their key ratios. We're gonna give the fundamentals, the ratios, and finally you'll get an Amazon valuation free of charge. You can use it any way you want it. So
You still
let's
keep
start.
in mind to do your due diligence, of course, and this is more like just a paper exercise, guys. So yeah, keep it in
Exactly.
mind, and it's also based on our assumptions. So don't take it as a financial, not a financial advice disclaimer coming in. Yeah.
Exactly. Also, let's go to their overview. So we can see already some quite some nice numbers.
That looks very dangerous, huh? Especially
That
like
is
if you
dangerous.
look at the price graph. Yeah, the once Amazon has showed their quarterly results, it went down like good 10% or something. That looked painful. That looked really painful.
Exactly. Yeah. So we did Nvidia. Do you say that Amazon is also kind of a tech company?
In a way, because they have a AWS and they
Yeah.
also aim to invest more in AI. But again, like their main sources of income are, let's say, advertising, their sales platform, like which is Amazon, right, and AWS. So
Yeah. So we can see here P ratio of 50, quite high. In tech, for example, it will be 34 on average. So it's already quite high PE ratio. So the gross profit margin looks really nice, 50%, really good. But the operating margin at 10% could be better. So preferably you want this to be around 20%, but we can talk about this more later. If we look at the company foundations, we see that they have been growing their revenue on 20%, which is really good over the past 5 years. But they have been decreasing their net income growth, which is not that nice to see. But of course, they have probably been investing a lot in this, AWS, like you said. So the free cash flow growth also declining. Probably some similar explanations there. So this is something interesting. I didn't actually notice that their long-term debt is not covered by their free cash flow.
well, it's probably we can check it later, right? But it's either because they just like they got more long-term debt because before, like back in the days when the interest rates were low, maybe they got loaded up on quite some debt, or the free cash flow went down. So it's one way or the other, right? That's why you got the red cross mark
Yeah.
in here. We will check it later.
Yeah, and then the average share buybacks of -1%. That's something you don't like to see. You want this to be, that they buy back the shares and not dilute you.
Yep.
Dividend growth 0%. They don't pay dividend. That's fine as long as they don't dilute you. It's all good. But yeah, just let them keep reinvesting in something that they know, which is the company itself and not the investor. So
Yeah.
yeah, we can go to the key financials if
Yeah.
you want. Is there something you want to pick out here?
If I want, yeah, of course I do. But I think this is also what we discussed, right? So revenue is going up, which is good. The gross profit goes up, great. Still, you can also see the corresponding increases in selling and general expenses, and surprisingly in R&D as well, because well, maybe you could have thought that AWS is already more or less established. It's quite a big, player on the market, but still going well quite up, even though it kind of leveled in 2024. But as well as the interest expense, right? It also went up. So that's probably the reason why, again, the free cash flow doesn't fully cover the interest expenses because they
Yeah.
loaded up quite some, right?
Yep.
What else is quite nice to see? Net earnings is positive, which is good apart from 2022. But then they actually, realize that okay, maybe we actually need to show some good results to the investors, just to make it all
And then
nice.
also I see here that, for example, if you go up, their assets they do cover their total liabilities. So that's also positive, right?
Yes, yes,
So
yes.
if they would be in trouble, they will be able to deal with this. Though
Yep.
this is not cash, but yeah, we can look at that later.
Yeah, but if we talk about free cash flow, right? So, for example, there's free cash flow of 45 billion, right? At this
Hmm.
very moment, but the long-term debt is 135 billion. So that
Yeah.
is not coverable at the moment, right?
Yep.
But also the question is, it's also something for you guys to look into. For example, what kind of debt is it? How further down the road is it? And what are the, let's say, the interest on it, right? Because if it's, let's say, 1%, right? Yeah, it's more or less peanuts. The Amazon,
Yeah.
if they're going to continue this way as in 2023 and 24, they'll be able to afford it, So that's pretty okay, but then again, for you guys to also check that later.
Yep. All right. And then we get to the key ratios.
Yeah.
So the net earnings ratio, yeah, that's what we discussed. Below 20%. So it's not the worst thing, but it could be better.
Yeah.
We aim normally around 20%. That's a healthy company.
Yeah.
Research and development, yes, moving towards into the 30s
That's
again.
quite a lot.
Around
That's quite a lot,
Yeah,
I would
around
say.
20% you would like to see, and also
Yeah.
for what, right? That's something again, like we should read the financial statements soon and see what they're spending their money on. But for now, on a first glance basis, it's just a lot.
Yeah.
And also, it seems that they cannot sell their products that efficiently either. They're selling like around 40%, 37% on average on selling in general. That's really high.
That is pretty surprising as well because I would say that Amazon actually has a lot of, let's say, ads capabilities within like Amazon, marketplace itself, right? So
Yeah.
why do they even need to sell it on any other external platforms if they already have the traffic, they already have the clientele, everyone knows about Amazon. So it's either again, just coming back to, let's say, Amazon growing in other countries, like for example,
Yeah.
Amazon, recently is developing a lot in the Netherlands where we are, right? So they go to
Hmm.
other continents and stuff, or there's something which we don't know or we don't
Yep.
understand, and this is also something as a future homework to do,
Yep.
But this is
Um,
interesting, yeah.
yeah. Yeah. So depreciation, gross profit, that's fine. Free cash flow growth, yeah, like
That's probably a
be,
bug because again, we're still in the in test environment, so we're gonna be fixing things here and there. But yeah, there's definitely, if we check at the free cash flow itself, we can see that it was growing from 2017 to 2019, but then we hit, let's say, negative territory, right? And then it skyrocketed into 23, 24. So it's okay. It's going in the right direction now, and hopefully, if the company is not gonna, again, aggressively reinvest in itself and just, kill the free cash flow again, then,
yep.
it probably the sun is gonna be shining there.
Yep. All right. What else? So revenue growth, we discussed these things, right?
Yeah.
We don't have to go over them again. Gross margin is looking good, but yeah, the
What's
operating profit
also a
margins are
very funny thing to notice, but then maybe that's just my kind of observation, is that right before, let's say, COVID times, when the interest rates were more or less like okay, right? Amazon was growing quite rapidly, but then after that, when they increased the interest rates and the whole economic environment became a little bit more careful in terms of like people just spending money here and there, or because Amazon is reaching certain point of saturation that they're like a big cash cow, their let's say revenue growth is also like going down steadily. So yeah, maybe it's not gonna be similar scenario like we see in Nvidia. When analysts are saying yeah it's gonna be growing, let's say 45% every year for the upcoming 5 years. So yeah, keep
yeah.
that in mind as well. That could be also one of the reasons.
Yep. All right, then we can just go down. If is there anything that you wanna highlight, or can we go to the valuations?
Yeah, we can do that. Yeah, we can
All
quickly
right.
do that.
So let's just yeah. If you haven't seen our previous video, this will look quite different than what you're used to from us. We made things nicer and easier for you. So again, we can start filling it in, and you can see how we use these numbers, right?
Yeah.
So for the free cash flow starting point, that's for the discounted cash flow formula. Now you can use last year, and it immediately takes last year free cash flow.
Yeah.
Easy as that. Projection period, again, we have it from 2, 5, 7, 10, 15 years. Okay, so we talked about Nvidia first. Previously, we gave it like 5 years. I think that, for example, Amazon is quite resilient. It's a lot of they are in a lot of businesses, so I would even say like 7, 10 years projection period.
Yeah, could be because it's kind of getting to the point of too big to fail, unless there's going to be something very disruptive, something very uncertain thing. But
Yep.
then again, we can, for example, account for that in margin of safety assumption,
Yep.
let's say. So I would agree with you.
Okay, so for the discount rate, again, we normally do this at 10%, but you're free to play with it as you want. Estimated growth rate, yeah, so that is something that we can look into. So, for example, they have been growing the revenue for in the past 10 years with 19%, negative 7% free cash flow growth on average over the past 10 years. So yeah, what do you want to take? I think somewhere in between is always going to be the truth. So, and you said they have been missing the revenue, and they are also projecting that they are growing with 7 to 10%. No, well, you said 9, 11%.
Yeah, but that's going to be for the upcoming quarter. So that's not
Yeah.
that far fetched. But if we, let's say, think about 10-year growth, it would be hard for the already such a big company to grow unless again they're gonna find some very breakthrough industry or breakthrough product or service, right? So if we also assume that they're actually gonna pay more attention to their free cash flow, they're gonna keep it in positive and growing territories, right? Maybe we can say, okay, in quite good positive estimates, they can grow 10% for the upcoming 10 years. I would say it's kind of also reasonable, and it's also like not lowballing in a way. What do you think?
Yep. Yeah, I agree. Do you want to know what the analyst thinks?
Oh yeah, we can do that.
No, yeah, it's
Sounds like
I can tell you already. I have
Yeah?
it in front of me as we
Perfect.
speak.
What is it?
It's 30.5% next 5 years every year, while they expect the S&P to grow 11% per year.
Free zero. Free zero.
Three
Wow.
zero, yeah, insane. Yeah,
Yeah.
you can check for yourself, audience, if whether that or not is realistic. But we keep it at this modest 10%.
Okay, let's do half of it. Let's do 15. Let's just
Okay.
be nice and say okay, it's gonna be doing very well. 30% is I don't think my
No.
finger will be willing to put the free zero on the keyboard in there. Honestly,
Exactly.
it just sounds painful.
The projected PE ratio. So we can see the PE ratio for the average PE ratio has been 72, which is quite high, but
Yeah.
because the highs are high and the lows are not really that low. So yeah, we can use 72, or we can use the current PE for the lowest. What do you think?
I would say let's not put it more than 40. And reason being that if we assume that they're gonna have a steady growth and steady improvement of cash flow, right, then the P is also gonna like level up, level equally similar to the earnings and cash flow, because the reason why they have such high PEs is just because they had also very big expenses, and their earnings are also like, they were very quite low, because they spent a lot on like, the improvement of infrastructure, building new warehouses, investing in AWS, and so on and so forth. So I would say no more than 45. Okay, let's put another 5 on top of it.
Okay. Required rate of return. So again, I just said that the S&P will return 11%. So again, if you want to buy, for example, index funds, you would expect between 7 and 10% annual return. But because you're stock picking, you're having a bit more risk, right? And you're also doing more research. So you want to be paid for that, basically. So we put it at 12% normally. And the margin of safety. I think we can lower the margin of safety compared to, for example, NVIDIA we did in the last video. So maybe around 20.
Yeah, 20, 15 even. Let's give it a
Yeah,
half,
15 is
because it's more like the environment which like Amazon works in, and the products and services we offer. It goes, you need it in good times and in bad times in terms of economic environment speaking. So yeah, it's and it also should be less volatile than Nvidia and these kind of guys. So
Yeah, exactly. All right, and then we press the analyze button, and what do we see?
Ooh.
We see quite an overvaluation. So with our estimations, you would probably buy around 75, and then it will be fair valued at 88 bucks. And here we see the current price is $167. So yeah, you can make of that what you want. But yeah, for me, it's quite clear that it's quite overvalued and also not really interesting on a financial fundamental standpoint. They have a lot of work to do on, optimizing and making everything a bit more smooth and overall just more profitable. All right, you can, if you want, Kirill, you can take it away and you can show some more features of our spreadsheet. Not spreadsheet, web app.
This sounds like PTSD.
It's new. It's new.
Yeah, so what we can do, right? So you can see another lovely button. For example, you can put this valuation to your watch list, and then it's gonna actually pop up in there. So, for example, if you can see, I already did some of the valuations, and here you go. You see, so you have Amazon, and all our valuation assumptions and everything would be saved here. You can also, for example, put the percentages in terms of assumptions when you feel like the company is very undervalued and very overvalued. So, for example, you can see some other companies here. But on top of that, you can also see the micro dashboard, which we also covered in some of our other videos. So before that, we would be just, scrolling around other, sources and databases and whatnot and showing you graphs. But now that would be accessible to you guys in here, in the apps, all centrally, all nice looking and everything, and it's all already prepared for you. So if you see, for example, a lot of reds, this is bad, a lot of greens, this is good. So it's also, we're trying to make it very native, very easy to understand for you guys. So yeah, something like that. Yeah.
Nice. And normally, if you've been following us for since the beginning, then you would know that I would say, where can we get a spreadsheet? It's a web app now. But now you cannot get it yet. We will, of course, put this up for still soon. But as Kirill said, we're testing it right now, and we're ironing out the final kinks, make it ready for you guys to enjoy. So the best thing you can do is follow us on our social media channels, and make sure to subscribe and hit the bell button so you're notified when we actually, have a launch. And of course, you can see some more videos in the meantime.
Yep.
With that said, thank you, Kirill, for being here, and have a nice evening, or day, or wherever you are.
Day, night, every time. Do your valuation, boys, and drink water. Have a good day.
Have a good one.
Boom, boom, chippy, chippy, go.